Okay, folks, welcome to another Thursday night Stock Charts Live. This is Bob Desmond, and what we're going to go over tonight are obviously the price action today. What did we do? How did we respond to the volatility today in the market? We're going to talk about the weekly charts and how we think we're poised to close out this week. And that gives us an idea. This is our cursory view as to how we might want to be positioned going into next week. Also, we're going to talk about some economic data that was released, some headlines. So let's get to it. First, let's do a rundown of today. You know, on a day like this, I've mentioned this in the past, we had stopped really going up at the beginning of April, mid-March. We were stalling out the Tues, S&P, IWM, the small caps, and we changed our bias from one that was mostly bullish. We had a hedge onto the short side, but that hedge morphed into more of a short position on the small caps, and basically it's done nothing. So what we did, rather than trying to take a directional play, we kept that short on. We haven't added to it. We shorted the Qs as well. And what we did is we took the position that we were going to be cash flow generators using options, selling premium, and it's worked out beautifully. So going into today, when our core position in the gold mining stocks, silver mining stocks, they got hit. They got hit really, really hard today. Now, those are core positions. Now, while we had some shorts that offset that core position, the pullback on the core position, it didn't totally offset it. So the first thing I look to do in a situation like this, it only takes a couple minutes, get small, get liquid, and take a look at your positions that are taking up a lot of your buying power and eliminate them. We were flat. I think we actually, no, we weren't flat. We took small losses on two positions, but what that did, those small losses freed up a tremendous amount of capital that was tied up in, it's called a put option strategy called a strangle. We had a strangle put on Coinbase, very volatile. They require a lot of buying power to maintain that position. And with Shake Shack, and that was a strangle. We booked profits on the put side. We took a small loss on the call side, but that was a profitable trade. So what does that do? It gives us breathing room. Because are we done going down, at least on our core positions? I don't know. We may be. We're definitely poised for a bounce. But is this the bottom? I don't know. So we want to get defensive. We want to get very, very small so that way we can maneuver. We're not being reactionary to the market. We're not dumping positions when we should be buying. I want to look for a good opportunity to add at bargain basement prices. But are we in the basement yet? I don't know. Once we see that we've stopped going down, then I'll look for intra-period breakouts on a 4-hour time frame, then begin to add to those positions, taking advantage of this pullback. Because the long-term thesis that we've maintained is that we are entering a stagflationary environment, and nothing that Powell said yesterday took away from our thesis. In fact, he validated it. And we're going to talk about what he said in a moment. But you have your algorithms that are out there. They scan or scrape the headlines for reasons to sell or reasons to buy. They got the reasons to sell, hawkish Federal Reserve statement, and they dumped. So now it's just a matter of seeing where these guys want to take this market. I believe I saw somebody before I logged on, Westlaw. It looks like sector rotation to the text. Yes. And he's very accurate, assuming no inflation or interest rate hike. Well, I could tell you right now, there isn't going to be an interest rate hike. There may be an interest rate hike in 2023, in all probability 2024, but the bond buying continues. The spending continues. The balance sheet of the Federal Reserve continues this week to make new all-time highs. Now over $8 trillion. Before the financial crisis back here, their balance sheet was around $881 billion. Think of this. They have to roll all of this off of their balance sheet. Do you know what that's going to do to the stock market when they do that? So buckle up. I think that what you're seeing right now, I always like to say that the knee-jerk reaction is often the wrong reaction. I'm of that opinion right now that we is still in the knee-jerk reaction to yesterday's announcement out of the Federal Reserve. Let's talk about economic data. First, let's say hello to people. Eric, hello. Westlaw, hello to you. Yeah, man, how you been, Eric? It's been a while. Jennifer Trades, what about SQQQ? Still like it. Right? Oh, I may have to stop out, to be truthful. Still like it right now. I may need to stop out. Larry, your opinion, will the 10-year Treasury rate be 2% or higher 1 year from now? That's a tough one. It depends upon what's driving the market right now. Why did the yield curve just completely roll over today? Is it the Federal Reserve that's managing that yield curve? That takes a lot of money to do. They're managing the longer-term yields. Short-term yields didn't do much today. They were pretty much unchanged. Whereas the longer-term yields, they pulled back dramatically. I think what it was, more so than the Federal Reserve, I think that what it was you had, let's go through the economic data. Retail sales came in with a big miss. Producer price index came out very hot. We know that. Empire Manufacturing Survey missed. Industrial production was better than expected. Building permits missed. That's a forward-looking indicator on housing. Housing starts missed. So when you fast forward from these economic reports, which are by and large negative for the economy, and you take a look at this morning's initial jobless claims, which came out hotter than expected, the trend has been down with this number, and this is a big miss on what was expected to be 360,000 initial jobless claims. And this is a weekly number. And when you take a look at the initial jobless claims, which come out weekly, and then you take a look at the monthly non-farm payrolls, net, the economy is still losing jobs. So I think that what it is the markets, or the bond market anyway, pricing in a slowdown in the economy. What they're worried about is the reopening, heroin injection, or the impact of the opening on the economy. They're worried about that already starting to fade. The problem is that you're not seeing inflation fade. Now, the Federal Reserve is saying that in 2 or 3 years from now, while inflation may be running hotter than 2%, it's going to come back down to 2%. Well, how is that going to happen if they continue to print money? Why would inflation pull back if the only mechanism that we have is to raise rates to bring down inflation? If you're not willing to do that, what else is going to cause inflation to come back in? That's an unanswered question. So I think that yesterday's announcement out of the Federal Reserve was one of the biggest nothing burgers. And frankly, I think the big shots on Wall Street look like a big fat bunch of you-know-what, right? Begins with a P, ends with a Y, or plural. Ends with a P, ends with an S. So what we're going to plan on doing right now is continue what we've been doing. We're going to look to build on our core positions because the thesis is as it has been. Inflation is here. We know it. The Federal Reserve admits it. And we know that the economy is now beginning to slow down. So why would the dollar rally? Would you buy dollars right now in the face of rising inflation and a slowing economy, stagflation? Think about it. It's crazy. It's crazy. So what we did today on our leveraged ETF NUGT, the gold mining ETF, we sold earlier in the month. I sold the 76 strike covered calls. Those will expire worthless. And then again today, those will expire worthless. I resold another batch of call options at the 66 strike expiring tomorrow. So we're just going to continue to generate cash flow. That's the name of the game, with a little bit of a defensive posture and a lot of liquidity to take advantage of any pullbacks that come our way. The Tues broke out today. Why? Because yields pulled back. Will yields remain down? I don't know, but think about this. People right now, because of today, if I had to ask you, are yields up or down on the week? The knee-jerk reaction out of most may be, oh, they're down. They're not. They're still up on the week. So we'll go to the weekly charts in a moment. We'll take a look at how we may close out the week. Remember, there's one trading day left to go. A lot can happen. And on Saturday with members, what we do, I put together the week ahead commentary where I go over the closing price action of the weekly charts. So that way we know with certainty how we want to be positioned moving into the new trading week. So if you're not currently a member, sign up, 14-day free trial offer, link below. All right, John Spencer's on. Good afternoon to you there. RL. Jennifer Trades, Qs are going higher. Look at all the charts in tech. They all look bullish. Maybe. It depends upon yields. If yields break out, remember, you have one trading day left to go. If you see a pop higher on yields, the S&P 500 broke out the other day. It pulled back. The Qs, yes, they broke out to new all-time highs today, and they'll probably move up higher. They probably will. But if yields jack up higher, if this is a knee-jerk reaction, you can expect you're going to see weakness on the Qs. And any strength whatsoever on the S&P 500 was purely the Qs. The cyclical names got hammered today. I remember you saying that about silver, Jennifer. So acknowledgement. I hate when people don't acknowledge people. 40,000 headsmen. What about gold? Love it. It's on sale. Would I buy it right here, right now? We'll talk about it. Financials. We kind of knew the financials were going to take it on the chin because yields were pulling in. Inflation is inevitable, and I am building a position on gold and silver little by little. Good. Disagree. Look at the chart for the Qs. Been bullish all week. Okay. Chris A. Hey, Bob, you take a look at TEL and Big C? Thanks. Bob, you've been saying Qs will drop since last November. They did drop. They're just now breaking out. So they did drop. NY Jets. Hey, Bob, is there really inflation or not? Well, if you have the Federal Reserve admitting that there is inflation on the CPI, they use the PCE, but if they reference the CPI, they use the core because it takes out food and energy. Either way you slice it, whether it be the PCE, the CPI headline, or CPI core, inflation is here. Now, the CPI, the way it's calculated nowadays, is that the way that it's calculated now is basically cost of living. Whereas back in the 70s and 80s, when you had the Volcker times where inflation was in double digits, that was actual prices for things, the cost of goods. Now you have hedonic adjustments. If beef goes up, they can eat pork because it's cheaper, and that flattens out the inflation curve. So right now, if you were using the CPI the way it was calculated back in the 1970s, you'd probably be in double-digit inflation. And Kyle Bass is on Twitter, he was on CNBC. I saw his clip on Twitter, and he was talking about that as well. Peter Schiff, same thing, saying that if they use the inflation data, the CPI as it was calculated back in the 1970s and 1980s, early 1980s, it would be well above 10% right now. 40,000 headsmen. There's a difference between extent inflation and the inflation rate. Extent inflation? I'm not familiar with that. In my jets is that French wise guy. All right, let's go to. We're going to spend time on the trip cues for Jennifer trades. Okay. Let's. Is this updated yet? All right, let's do this. They finally updated the U.S. dollar. Yields should already be updated. All right, so let's begin with the U.S. dollar. Inflation is already exists and persists, no doubt about it. And we've been saying that, right? The funny part is that whenever you go back in history, the prelude to inflation is usually, I shouldn't say always, because I don't know that to be a fact, but it's usually that you get inflation first in asset prices, whether it be real estate, stock market, etc. Do we have that? Check those boxes. So now you're getting consumer inflation. So let's begin with the 10-year yield weekly chart. Now, the 10-year yield weekly time frame is up on the week. We have been attempting to break out. We had a very, very bearish week last week. Remember that. But this week, no follow through to the downside. Now, to Jennifer's point, and this is where I will side with her on this, is that the stochastics are showing that we're losing momentum on the 10-year yield. So we just may get lower lows here because these stokes are trading down below 50. Rallies tend to fade. What happened last week? The rally faded. What happened this week? The rally's fading. So for all I know, she may be right. And if she is right, we get that pullback in yields. The Qs are going up higher. But if we see a rebound tomorrow, and we know that by virtue of the fact that we have that one trading day left to go, we can easily see a breakout tomorrow on a rebound once everybody figures out where they think this market is going and the economy is going. I don't think they know. I've heard opinions, and these are from people that I respect all over the place. You want to talk about a dot plot? Really good, intelligent guys, gals too. They're confused right now. I side with the Peter Schiffs of the world, the Jeff Gonlocks of the world, Kyle Basses of the world. So I think that we're in for stagflation. In fact, you had Paul Tudor Jones. He's got about 10% in gold now. He plans on investing more in the inflationary trade. He came out just the other day. This is not old news. This is new news. So I'm in fairly good company with the opinion that I'm carrying right now that we're entering a stagflationary environment. So yields are pulling back this week off their highs, but still up on the week. Let's take a quick peek at the daily chart. I gotta delete this. I keep doing that every week. That's a duplicate weekly chart. Now, in the daily time frame, we did break down today. Now, we could easily pop up higher tomorrow. If we do, watch out for the Qs. If we don't, if we see a continuation move lower, especially a break below 1450, that would be lower highs and then lower lows. Expect, where would be the next support level? 14. And for a real extreme pullback, a filling of the gap right around, let's just call it 1.2 on the 10-year. And if we do get a continuation breakdown, you can bet your bottom dollar that the Qs are going to launch, semis are going to launch, and you're going to want to be long of those growth names. If if we do happen to gap up, and I'm not predicting it, I'm 50-50 right now as to whether or not we can get a gap up or a gap down. I'm really walking, I'm being milquetoast right now, to be honest with you. I'm not making a directional call because I continue to think that we're seeing a market that is in a knee-jerk reactionary phase. They don't know what they don't know yet. They're figuring it out. When they do, you'll see a reaction in the market because the algorithms will rebalance their portfolios accordingly. Anthony, you called inflation coming a long time ago. Thank you, Anthony. Call it cupcakes. Lynn Wood, I haven't heard about him in a while. Is he back in the news? Character. Okay. Hey, Falcon, how you doing, buddy? TLT. Weekly chart. We are up on the week. Up a 0.5 percentage point. We have faded off the highs of the week somewhat. Volume really, really good. So money flows moving into bonds. Now, the question is, are we setting up a right shoulder of a head and shoulder setup? Left shoulder, head, right shoulder. Here's your neckline, 45-degree neckline. We don't know yet. We're not going to trade off of this. It's just an observation. Most of the times, these observations get negated. You get a continuation move up higher. But it's worth noting that you have a possibility of a head and shoulders setup on a weekly time frame. And if this breaks, you could bet your bottom dollar that the 10-year yield is going to be ripping higher. The tips. Weekly chart. Outside reversal bar. But the last I looked, big volume this week to the downside. The last I looked on the daily time frame, we had a bullish key reversal. This is ominous. These RSI. If we do continue to break down here on the tips, this is a real bearish setup. We didn't even have the strength to get back above 70 on the tips. But one trading day left to go. Now, you had a mother of a bear day yesterday, right? And this is what I mean by the algorithms. They scrape the headlines and they trigger. They just sell. No thought, no nothing. And they dumped the tips. What did they do today? Yes, continuation breakdown, but a bullish key reversal day, and they closed up on the day. So is this a sign of a market that is worried about deflation or inflation today? I think that they're worried about inflation if they're bidding tips. And this is not mom and pop buying 100 shares of the tips. This is this is institutional buying. So the chart on a weekly time frame still looks very weak to me. Are these done going down? I don't know yet. We need to see a higher low get put in, perhaps a couple of days of an orderly pullback, higher low, continuation move up higher. Right now, our indicators are telling us lower highs, lower lows on RSI, same deal here on Stokes. So volume and price was good today. Was it a dead cat bounce? We have to make the assumption that it was. We want to think worst case because hope is not a strategy. So again, it goes back to the strategy going into the day. We got small. We got liquid. We didn't make any major changes to our portfolio except for we took our speculative cash flow strategies off the table, freeing up a lot of leverage. So that way, if we want to do things, we can do it. And we're not trading emotionally. And that's the exact thing we want to avoid is emotional trading. So going into a day like today or going even into tomorrow, the goal is not to make money. It's not to make money. It's to manage risk. Simple as that. So Let's continue. The dollar, a huge move up higher. And this to me speaks volumes. You had a lot of money. Yes, Westlaw said it earlier. You had a lot of money that segued over into tech today, but a lot of it found its way into money markets, right? People went to cash a lot today. What did they sell? Transports, banks, anything that's cyclical, they sold. Energy, took it on the chin today. A lot of those buyers out there, they're not going to go into tech stocks. It's too speculative. They'll go into cash, sit there, and they'll put their money back to work when prices bottom out in those cyclical names. So the dollar, an amazing week so far. We're right up and into the 50-period moving average on a weekly time frame. The real story here is not the weekly chart. It's the daily chart. Now, the daily chart, this to me screams of a short squeeze and an unsustainable rally. This is not going to end well. This is the second consecutive day where we traded above our third standard deviation Bollinger Band in red. To be fair, we did close above the 50 and 200-day moving averages. The indicators, at least on the Stokes, are a bit overbought. So is this rally for real? We don't know. We'll know if we get a pullback, a higher low, and then we break out to new higher highs. To me, this is just emotional buying of the U.S. dollar. Yesterday was all algorithmic. Today, emotional. The VIX. Weekly chart. The VIX is obviously up, but we have not broken out yet. You could see that we're forming another compression zone. Just like you had back here, compression zones. And it looks like it wants to break out. So VIX is consolidating here. Let's go to a daily chart. That's a monthly chart, daily chart. Reversal day today. We hit a high of 19.22. There's our new resistance level. We broke out yesterday on the VIX daily time frame. Today, pull back and a retest. The Dow transports. We spoke about this the other night on Market Wrap about on a daily time frame, the transports had broken down. They tried to recapture. I'm going to go to that chart in a moment. But the transports confirmation breakdown now. We have a double top. Now we have lower lows. The path of least resistance now on the transports is to the downside. Jody, no worries. John Spencer, for the overall market to go higher, maybe big tech needs to go first, then broaden out. Biden wants his midterm votes. Yeah, could quite possibly be. I mean, you know, after COVID hit, what was it that drove the stock market higher? It was the exact same names that drove the market up higher today. Those are the ones that led the market back then. The cyclicals took it on the chin, and they stayed down for a while, ultimately catching up. Then you had the sector rotation. We nailed that call. And can the Qs move up higher from here? Yeah, but there's something in the back of my mind, and I'm going to go to it in a moment, that is certainly not helping the case for the Qs. and it's technical in nature. So bear with me for a moment. We'll go to it. When we talk about the cues, I'll talk about another chart as well. Let's go to the daily chart of the transports. All right, so here was the breakdown. On the 10th, attempted to recapture multiple times, continuation breakdown today. So the transports are in all sorts of trouble. Volume rose today. Stokes are very oversold. One trading day left to go in the week, but the transport's not looking good. The Dow Jones. So we had a breakout 2 weeks ago on the Dow Jones. And what happened was that we got a retest last week. It held. This week, were we to have closed out the week today, this would be a breakout point failure, meaning it's a bull trap. Traders bought the breakout. Now they're getting stopped out because there's no follow through, and now there's a potential for a failure of this breakout. But by tomorrow, 4 p.m. Eastern Standard Time, we may be back above this support level, and maybe we'll head up higher next week. So this is just a cursory view. It's giving us an idea of how we're setting up to close out the week. And for the cyclical names, it's not looking good. Now, the Dow on the daily chart, yes, down over half percentage point on the day. We tapped the third standard deviation Bollinger Band, bounced a bit. There could still be some downside here. Volume rose. The S&P 500 weekly chart, were it not for the cues, the S&P would be in all sorts of trouble. And what I do want to point out is, despite the support of the cues today, what's going on here? Let's try that again. Stockcharts.com needs to get its act together. They won't let me annotate. Piss me off. All right, so what I'm trying to do is show you that on a weekly time frame, RSI may, one trading day left to go, may be breaking down, because at current we are down below this lower band of support, possible lower high on stochastics. The breakout here, we've had broken out the week of June the 1st, is now under pressure with an outside reversal bar on the week, aka a bearish engulfing. For those that are new, there's a 5-part video tutorial below. It's free, and I walk you through my 5 top favorite candlestick patterns, and one of them is the engulfing pattern, and this is one of them. Daily chart. Oh, how's volume so far this week? Volume is very light. Let's see how they did today. All right, so this is again a weekly chart. Okay, so ultimately the S&P closed down on the day slightly, basically flat. Doji star formation, close to a Doji star formation. Volume rose, and it's rising sequentially. We talked about this the other day, possible double top on Stokes, and now that is confirmed. Small caps, of which we are short, and which also broke out several weeks ago. But that breakout is now under a lot of pressure with an outside reversal bar. Ultimate oscillator. I pointed this out the other day. We had a breakout on price, but the ultimate oscillator was failing to confirm the breakout, and in fact, it was hugging the lower band of support. Today, we broke support, assuming that we close there. That is a bearish event for the small caps. We did bounce off the 20-period moving average, daily chart. The daily chart, broke daily support. So this breakout, which occurred here on June the 8th, has now failed. Volume, huge volume today. MACD went negative today. You can see the histogram bar, negative. Let's go to the 4-hour chart. All right, the afternoon session was pretty good. Stokes still weak. RSI still weak on a 4-hour time frame. Volume into the close was good. Let's check out the final 5 minutes and how they looked. How was volume? Good volume into the close. Now, the reason why we shorted the small caps had nothing to do with the daily chart, had nothing to do with the weekly chart. It had everything to do with the monthly chart. And this is what some people don't get with the way we look at things. I'm not looking at a trade from a daily time frame, not even from a weekly time frame. We're looking for a macro move here, and ultimately it's to the downside on the IWM. Go back in history. You're going back here to 2002. I guarantee you can go back as far as this chart goes back. You will never, ever find the share price of the small caps this far extended from its 48 period moving average, which is the 48-month moving average, and never on a sequential basis trading up and into the third standard deviation Bollinger Band for months. So, and even to have RSI, it was higher, but it's still above 75. That's a bit overbought, right? The only thing keeping it up is the Federal Reserve, and they're issuing, I don't deem it to be hawkish, but they're issuing hawkish statements. And I think underlying the concern of the market is this, is that the Fed got it wrong about inflation. They got it dead wrong. And what they're worried about is if inflation keeps moving up higher. This is what I believe is really the concern about the markets from the big institutions, is that if we see a big spike or consistently and persistent higher highs on inflation numbers month after month, will the Federal Reserve have to come in and act? Because think about it. Where are interest rates going to be 0.75 of a percentage point 3 years from now, 2 years from now, when they decide to raise rates? Fed fund rates, I should say, at 0.75 of a percentage point? Really? You still have negative yields adjusted for inflation. So how is that fighting inflation? They'll still be way behind the curve. So I think the market's afraid that the Federal Reserve is going to have to act a lot more quickly, and possibly a surprise rate hike. And that's what has everybody freaked out. Now, I think it was John Spencer that mentioned earlier that you had the midterms coming up. And some people may say the Federal Reserve is not political. No. They are very, very political now. Those days are over. You have Janet Yellen at Treasury, Jay Powell, who learned how to play the game, because I disagree with President Trump on this completely. I'm not going to carry water for anybody. I like the guy, but he hammered Jay Powell. Jay Powell was doing the right thing. He was rolling off the debt off the balance sheet, and he got hammered for it. So, still a Trump guy, though, my man. So I disagree with President Trump there, but IWM is in a lot of trouble here. And if we continue to break down on the small caps, we're going to be looking to build on that position. Now, moving on to the Tues, which has been the debating point of the day. Okay, so the triple Qs are an index in and of themselves. You have RSI on a monthly time frame at 78.73, near 80. Think about that for a moment. Now, does that mean it can't go up higher? Well, looking at this chart here, it looks as though, guess what? It's going higher. Maybe. It all depends upon what the bond market decides. If they decide, no, man, there's no way yields are going to stay down this low with inflation coming down the pike. Not coming down the pike. It's here. Inflation is here. There's no way that yields could stay down this low. If that's the case, forget about this continuation breakout happening. It'll fail. However, if the bond market prices in a slowdown in the economy and they ignore inflation thinking that, all right, you'll see deflation due to the fact that you're going to do the slowdown in the economy, then the Qs can break out. It has everything to do with the 10-year yield. Everything to do with it. If anybody thinks it has anything other than that, they're crazy. It has everything to do with the 10-year yield. So if you feel comfortable with buying the Qs with RSI at 78.73, go for it. If you feel comfortable with the largest component of the triple Qs is Microsoft. Microsoft has a quarterly RSI of 94.71. It gets better. On a yearly time frame, Microsoft has an RSI of 94.90. Think about that. If they disappoint on earnings, if they get a massive downgrade, if whatever, there will be a pin for Microsoft to burst this crazy, crazy bubble. And when it goes, it's going to be very, very difficult because it's the largest component by far of the triple Qs. Second largest is Apple. Let's bring up Apple. Apple is not as overbought on a quarterly time frame, but Apple on a yearly time frame. Look at Apple on a yearly time frame. 96.28. I haven't looked at Apple on a yearly time frame in a while. 96.28. Monthly time frame or quarterly time frame. Not as bad. 79.11. If these two go, forget the Qs are done. Back to the Qs. Monthly chart. Until that bursts, this is a bullish chart. I will agree with Jen. Jennifer, right? Bob, I agree with what you're saying about the 10-year yield affecting the Qs. Yeah, it's reasonable, right? I mean, we could overlay, I don't want to waste everybody's time, but if you overlay price performance of the 10-year yield and the Qs recently, not always, you know, when yields first started going up at early to mid 2020, after the sell-off, the COVID sell-off, the Qs went up too. They traded in tandem. It's just that the 10-year yield reached a point at which it just wasn't good for the tech stocks. And that's when tech started to underperform. So if you get a spike up from here on the 10-year yield, that's what's going to prevent the Qs from moving up higher, especially with an economy that may be slowing down. We don't know it yet. We'll wait for the next GDP report. Microsoft, Jen, Microsoft on a short-term basis, I agree, looks good. I mean, the other day it looked horrible. I mean, yesterday it got clobbered. Today, outside reversal bar. It looks as though it wants to go up higher. Good volume today. I will point out, MACD histogram continues. Take a look at this bar. No new higher high today on the MACD histogram. I really don't use the lines that much. I focus more on the histogram. Look at this price action today. Yet the histogram, no move higher today. Just basically flat versus yesterday. Tomorrow's going to be an interesting day. Back to the cues. Let's drill down to the weekly chart. They changed fund families. Where is it? Here we go. So weekly chart looks good. This is what? The 1, 2, 3, 4, fifth consecutive week higher. Volume has risen above prior weeks, but still below average. Daily chart. Very consistent with what you saw in Microsoft. I mean, you compare Microsoft chart and the cues on a daily time frame. They look exactly the same. The exception is that your histogram bar on the cues did rise versus yesterday. That was not the case with Microsoft. The banks, I mean, and this is another reason why you're seeing breakouts right now. You had a breakout 2 weeks ago to new all-time highs on the banks. 2 weeks later, we have a breakout point failure. So keep that in mind. Yes, the cues may be breaking out right now. The question is, does it hold it? Where will we be 2 weeks from now? So that's the only reason. I've never added to that short position of the cues. It's an opening position. I've had no reason to add to it. And I may need to stop out, and because I didn't add to it, the loss will be minimal. We're not going to fight it. If I'm wrong, I'm wrong. So we'll move to the sideway. But I want to see how we close out the week and how potentially we open up next week. Do we get a continuation move up higher? I want to be convinced. So because if I was short the banks back here and stopped out, I would have had my head handed to me. I don't believe that yields should be going down right now. I think they should be moving higher, and that's why I'm holding on to that short Q position. Daily chart, the banks. What are we down? Nearly 4% on the week on volume. Outside reversal bar today. Bearish engulfing. Big volume. So if I'm right and yields begin to push up higher, you're going to want to start taking a look at the bargain basement prices on the banks. Although Jamie Dimon, the day the banks really started to fall apart was when Jamie Dimon came out and reported that their trading revenues for this quarter were going to miss by a big margin too, like 30% in that ballpark. So that's also impacting the money center banks. Technology, I got to blow through these. Good week. It's going to look consistent with the cues. I'm not going to spend much time here. I would really prefer to take a look at the semis. Semis not a great week. Think of all the hype about the shortages, whatnot. Look at the semis. No new all-time high. An up day, but nothing outstanding. I mean, money really flowed today in the mega tech names. What did Tesla do today? Up nearly 2%. Neo. I'm just looking at the speculative names. Neo did good. Biotechs looking interesting. I don't like the moving averages. LABU up today. This is a leveraged ETF, so don't be impressed by the percentage move today. Leveraged ETF, 3 times. Consumer discretionaries, really, really good price action this week. I'm shocked, especially with retail sales miss. We broke out this week. Daily chart, no breakout in the daily time frame. I'm still concerned about a head and shoulders setup. Left shoulder, head, right shoulder. Good volume today. Energy, horrible, horrible price action. The thing to remember about money flows is this: is that while the people that own, or the funds, or the people that own energy, transports, the banks, they're not going to just go jumping dollar for dollar from an energy stock, which is low beta, into a high flying tech stock. They went into the Qs, they went into the mega tech and cash. And that's why I think you saw the dollar spike up so high. Now, if yields rise and you see the banks move up higher and you see energy move up higher, the transports recover, well, then the dollar is probably going to roll over because you're going to have money leave the money market accounts, going back into these cyclical names. So, just a theory. I'm pressing on. Oil, down on the week. Watch oil. As goes oil, so goes energy. Emerging markets becoming very interesting. Love to see lower lows. The stronger U.S. dollar is going to do damage here, but this pullback is probably the pullback ultimately to buy. I'm not ready yet, but it's certainly on our watch list. Gold. All right, is it time to buy? Somebody asked that earlier. No, it's not time to buy yet. We don't know whether or not 1750 is going to hold. I think that what we need to do is we need to take another nosedive. And what you want to see is, let's get an example here. Here, perfect. One of my top favorite candlesticks, right here, the week of the 30th of September, we had a continuation breakdown week, but what do? We reversed to close up. And while ultimately it wasn't the bottom for gold, it was definitely a turning point where we got to pull back an undercut double bottom, but from there we ripped up higher, went on to new all-time highs. So this ultimately is what I would love to see, not this week, but next week, a new lower low and a bullish reversal bar. That would be a signal to me that we have buyers below willing to defend the 1750 mark. It's hard to believe we were at 1900 this week. I mean, this is nuts. This is bananas, this type of price action on gold. But if you're going to trade these names, you have to get ready for this kind of volatility. You have to be prepared. I view it as an opportunity. And we closed out the day down below the third standard deviation Bollinger Band, way down below. We're going to pop here maybe as soon as tomorrow. Massive volume. So why wouldn't I buy if I believe that there's going to be a pop higher and we're trading down below the 2 and 3 standard deviation Bollinger Bands? It may just be a dead cat bounce. I don't know. I'm not into these trades for a dead cat bounce and then out. I'm into it for the long haul. So I want to buy when I know the selling is done. So we'll watch volume. We'll make sure that it drops off. We'll watch the weekly charts. We want to see a bullish reversal bar on a weekly chart, daily chart. We'll pay attention to those. And if they hold, they don't break down below those support levels, then we know it's safe to go back in the water. Dip your toe in, nibble, nibble, nibble. The GDXJ, of which I own, hammered this week. Hammered. Let's go to my annotated chart. Now, am I upset about it? Not really. Disappointed? Sure. Now, what would have me very, very upset is if I was very, very overweight already of the GDXJ. If I didn't have any room whatsoever to manage my position, maybe sell naked calls, deep out of the money naked calls as a defensive mechanism, sell naked puts to generate cash flow, or get shares put to me if they hit a real strong support level, say at the 46 strike price. If I weren't able to make those moves or simply to be able to buy more GDXJ on a good setup, I would be pulling my hair out and ripping my eyeballs out because I screwed up. That's why we added extra liquidity today to be able to maneuver, to be able to manage these pullbacks. And that's why so many people blow up their accounts. They're too overly leveraged. There's nothing wrong. Raise capital. Get the emotion out of your trading and watch for your setups. What am I doing here? Oh, I want to set up support levels. I'm getting really long in the tooth. I will take a few chart requests. I think ultimately here, the problem for the GDXJ is twofold. Let's, I got to change this again. All right. God damn it. So right now, where we closed today was right at a weekly breakout point. I don't want to see us close back down within this downtrend channel. That would be concerning to me. Because that would be a breakout point failure, and we can go considerably lower. Daily chart. Now, the fact that we closed down below the third standard deviation Bollinger Band, Stokes are extremely oversold. I think we're due for a pop here, especially if, remember that dollar, we went over the chart of the dollar earlier. It's very, very overbought. It's going to pull in. With that pullback on the dollar, you should see a rally in gold and the gold stocks. So I think that we may be okay, but hope is not a strategy. You got to wait and see how it all unfolds. And we'll go over the charts with members on Saturday, the weekend commentary. We'll talk strategy. SILJ, the silver miners, hammered this week. We have not broken trend yet. Volume high. I'm going to blow through these. Silver broke support, bearish reversal bar. At support at $45 per share. Volume high. We're still long of Coinbase. I still like the price action here. What do we close? 230.66. I'll probably sell covered calls here against Coin. That's it. Let's take some chart requests, and I'm going to log off. I got to check the members area first. I'll take super chats, and if we have time left, I will go to a few requests from the audience. We'll go to about 7:10. It's 7:01. The screen was so slow. All right. While I wait for that page to load. This is our Slack forum. I just got an alert. Somebody may have just sent me a request. All right, so we have John Spencer, naked. To answer your question, I'm not sure. NAKD, QDEL, Newmont. All right, John, you got it, pal. Back to the, I haven't been looking at comments. Disney, communist company, but I'll do it for you, Jody. William, hey, William. BA. And smash that like button. Who said that? William, always a good fella. Smash the like button, please, folks. Helps me out with YouTube algo. NAKDQDEL. New. BA. Diz. We're going to shut it off there. You like that, Jen? Let's do this. We'll use our friends over at TrendSpider. Folks, automated technical analysis at its finest. There's a 35% discount code below. I'm not going to go through my long-winded pitch tonight. I'll let the product speak for itself. All right, let's... You're welcome, Jody, anytime. Naked. Naked Brands. Ooh, wow. There we go. What's going on here tonight? There we go. You got a lot of resistance up here at these moving averages. How does the monthly chart look? Naked Brands is selling for 67 cents? That's crazy. Frankly, I'd wait for 57 cents again here. I think you're going to get tapped. And if that fails, I would bail. I think you may get hit. You know, you have, what is this? The 21 period moving average, weekly time frame. That's the exponential moving average acting as support. How do we do today? Daily chart. Yeah, we had broken out here on the 2nd of June. These are the automated trend line. I'm going to take them off. All right, this is a big time saver, folks. Put them back on. These were resistance levels. Was support here, resistance here, breakout. This is what I mean when I say it's not going to end well. You trade up and above that third standard deviation Bollinger Band, this is what you get. Now, this came to an extreme because we broke back down into a trading range on June the 10th. Yesterday, we broke daily support on a gap down. This was not the Fed announcement. This had everything to do with the company and sentiment. And today, we closed down below a bunch of moving average. I would not be a buyer here. If you get a pullback, if you're looking for an entry point before that 57 cent mark, watch for filling of the gap at 15, let's call it 60 cents. 60 cents. We'll create an alert there. I don't want to leave too much sensitivity. If I were bullish on the shares, I'd leave a good amount of sensitivity, but I'm not that bullish. And we'll keep it active for 12 days. Looks like a good number. 12. Good. Set it and forget it. You know, if it begins to break back out above resistance, then that becomes interesting. Strength. And if you're wondering why I set a breakout on a 4-hour time frame, but a retest on a 10-minute time frame of support, it's because I only care about a close above a breakout point. I don't care if it's trading there on an intraday basis. What matters is, does it close above that breakout point? That's all that matters. That's why I use a 4-hour time frame, maybe an hourly time frame, a 90-minute time frame. I switch it up. But ultimately, what matters is the close. Now, in a retest, if you're bullish, you get that alert that fires off, you want to take that opportunity to execute, because it may not stay at that support level very long. And our alerts are set. Set it and forget it. ODEL. Typo. Oh, is that QDEL? Maybe it's Q? Oh, damn it. There we go. Can't read my own handwriting. Okay. I literally have the handwriting skills of a sixth grader. And that's insulting sixth graders. All right. QDEL. Monthly time frame, we're down on the month, but this is not a horrible chart. You could see that you have monthly resistance above and support below. Now, we have rallied off the lows of the month, so let's take our crayon out and memorialize support, because this support level here was resistance back here. So it has significance. That support level is at 104.42 per share, weekly chart. Good support here. So we're down on the month, but all down months aren't the same, right? We're consolidating with a bias to the downside. We're down on the week. You do have resistance above, right? Here at 128.61. So you're in no man's land right now. This is a stock right now. I don't know if it's optionable, but this is a stock right now where I'd be looking at selling premium, selling straddles and strangles. Not straddles, strangles. I don't do straddles that much. And if you're really bullish on it, sell a naked put and wait for the breakout. I would not sell naked calls. I would with a straddle, though, a strangle. Daily chart. Daily chart, flopsy mopsy here. There's just a lot of resistance above. That's the negative. The positive is this, is that you're setting up for a possible higher low. So now you have your triangle formation, and we bounced off the lower band of support today. Do we break out? Let's set up a alert. Again, all we care about is a breakout. And we're set. Just keep in mind that if we do break out, you're going to have resistance right up at around 114.68. Otherwise, it's constructive. Down on the month, but still constructive. We haven't had a significant breakdown technically. It's just simply consolidating. Newmont. Is it Newmont? I think so. Oh, it's not. Puxon Limited. Yeah, I think you got to avoid this one, John. This is under a lot of pressure. And right now we're trading below last week's lows, which just happens to be a support level which is held for the prior 3 weeks. It's probably not going to hold this week, but one trading day left to go. We don't know. We want to keep an open mind. Volume is high. And the other thing here is that you have a lot of, I don't even want to use a horizontal. Let's go with a vertical. A a lot of resistance above. So I wouldn't be a buyer here. I would wait for a rally back to close above. It's got to close above 175 per share. Then it would become interesting, but I would stay very small until ultimately you got the breakout above resistance. And we'll keep that. I've been using 12 today, so I'll stick with 12. There we go. Daily chart. Yeah, so here's a close-up of the breakdown that we saw today. And in fact, this line here in red is an automated algorithm trend line. Did I lose everybody? I'm going to take it off. Hopefully I didn't lose everybody. My screen just went black for the YouTube live stream. I'll assume that I'm still live. I'm going to throw it back on. And we broke down yesterday, and then another breakdown today below another support level. The one thing I will point out is that your volume bars are declining, which is a good thing. So if you get a pop-up higher tomorrow, all is forgiven. And you could look to buy the shares. But right now, I would be very, very careful. All right, everything just came back on. Cool. All right. Boeing. Get log off. There we go. Boeing's just stuck in a trading range. Down on the month. Daily chart, weekly chart. I think it looks interesting. It's coming in nicely. Would I buy it here right now? I would love to see a retest of 231. Is this alert still good? Yeah, it's still good. I've had this active for a while now. Daily chart. Yeah, I think you may get another move lower here. I have some sensitivity on this support level. And if volume drops off, I would entertain nibbling at support here. But if we fail to hold this support level, we have automated support. I'm going to take it off, put it back on. Down here in blue, green. Blue is 226.78. Green, 223.98, 224 per share. So I think it looks interesting. I like it. I'm not ready yet. We are at a volume shelf. Did we close down below it? Yes, we did. What I will do is this. Because I am very interested in Boeing. We were long of it. I booked profits on it. We'll keep this active for a month. Daily breakout, good, good, good. And we're good. I'm not ready yet. Bullish on Boeing, no longer term. I just saw it on their Twitter feed. They just launched the first autonomous midair refueling tanker for the U.S. military. They refueled I think an F-18 Hornet. It was amazing. No pilot. It's amazing. We're in a whole new world. So they're at the forefront of this stuff. So I like Boeing, especially now that the economy is opening up. Disney, our comrades over at Disney. I believe they sell Coca-Cola at Disney. All right, so we're in a downtrend. Volume on the month is fairly light. We may come in on par if we could stay consistent with where we're at current with daily volume for the month of June. Coming on par with last month. That's just pure speculation. Weekly chart. We're at critical support. I say potential short trade because I don't know if the risk reward is worth it. Because you have support right down here at 168. So where's the support level? You know, you don't have much room to the downside before you hit support. Maybe you want to sell a naked put. If I did short, I'd probably use a bear put spread. So that way I'm financing the option purchase and not just paying out in cash. Daily chart. Daily chart, we closed up today, but we faded. And again, this is an automated trend line. I'm going to take it off. Put it on. This prior support level, which failed yesterday, was resistance today. That leads me to believe that this support level, which we bounced off of, where we have our alert set, is in jeopardy of breaking. If it does break, expect support down at 171.83 thereabouts. Where do we close again? Yeah, 174.70. All right, folks. With that, folks, everybody have a great night. Thanks for joining in. If you could smash that like button, it really helps me out. Everybody have a profitable trading day tomorrow. Remember, this is an emotional market. Don't get emotional. Get liquid. And then make your trades with rationality. And watch the bond market. The 10-year yield will dictate everything. And watch the dollar for your gold trade. The dollar is key to gold and silver. With that, have a profitable trading day tomorrow and a great weekend. Be well.